following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host, David Blain. We thank you for joining us today. Broadcasting on 94.1 FM WNBU, as well as cable TV 10 in New Bern. We also have streaming video and audio from the website. Maybe you are joining us at a later time from our website, dlblain.com. We welcome everyone, the different avenues we have to present our views here. We hope that you enjoy the show. We welcome your comments and questions as well. Our show is for you. I mean, we don't want to just sit here and have me talking about what I want to talk about. We want to make sure that it's interesting for you. So we appreciate everybody that calls the office. Of course, our number, if you don't have it, is 252-633-0107. People also send us emails. The email for the direct to the show is allthingsmoney@dlblain.com. And of course, you can always go to the website, hit the big Contact Us button in the upper right-hand corner and let us know what you're thinking. If you like what we're talking about, if you don't, another topic, we'll be happy to cover it. What I want to do today is I want to talk one thing. One of the number one questions we get, besides is the stock market going to go up or down, which I have no idea. On a short-term basis, it's random. Maybe one day we'll get into how to look at the long-term returns of the market. Longer-term returns of the market, whether bond or stock market, are somewhat predictable, not on a point-to-point estimate, but when looking back, for example, a 7 to 10 year return, looking back at a compound annual return, they're actually somewhat predictable. But I don't want to get into that today. That's the number one question we get is the market going to go up or down? We have no idea. The second one is, right now, should I get rid of my bonds? You know, bonds are paying nothing right now. The interest rates are very low. And people have this sort of paranoia about rising interest rates and inflation. And so I thought I'd touch on that. Then we want to get into some college things. You know, it's getting to be spring here. Tomorrow's the 1st of May. Kids are starting to graduate from high school. They're getting those acceptance letters in and figuring out where they're going to go to college. So we wanted to cover a couple things about college planning as it relates to finance for you as your kids head off to college, or maybe you're still a few years away. Maybe we'll give you some ideas to think about ahead of time. Speaking of which, I serve as the local volunteer admissions office representative for the United States Military Academy at West Point, where I graduated in 1989. And we have two young men from Eastern North Carolina, Chris Linder from Western Carteret High School and Joseph Whitley from Havelock High School, that have been admitted and accepted to West Point. So I just want to give them a quick congratulations, and I'll be going out to their high schools later this month or later next month in May to present their acceptance to them. So congratulations. All right, bond investors. So when we design portfolios for our clients, we use a diversified mix of growth assets such as, U.S. foreign stocks, small stocks. We use fixed income. We use corporate bonds, treasury bonds, things of that nature. We mix in some real estate, occasionally some commodities and other asset classes to build a diversified portfolio that, when taken as a whole, helps people progress towards whatever rate of return that they need, whatever their goals are, within a certain risk tolerance. One of the main reasons we put bonds or fixed income in the portfolio is to help buffer the volatility of the more volatile asset classes such as stocks and commodities and real estate. And so a lot of people today are questioning the value of bonds, when they only pay 1 or 2%. They say, well, is it really worth keeping them in there? And our answer is, it is still worth keeping them in there if your risk tolerance is such that you cannot handle the volatility of more growth assets. And I know that the year 2008, every day that goes by, it gets further and further from people's memory. But, I was doing this then. I was also doing this in the year 2000 when the markets really crashed then. And I've seen the reaction of people. And I've also seen that fear sort of fade away until the next crisis. And what I do know is that there will be another crisis. There will be another bad bear market that hurts a lot of people and people lose a lot of money. It's just the way investing works. If you go to our website and search the archives for why bear markets are necessary, I don't want to get into all that today, but bear markets are a necessary part of investing. So we've been hearing since 2008, we know with the government printing presses running full speed, cranking out money, and Ben Bernanke, spending that money, buying $80 billion of mortgage assets a month. We've been hearing about, well, inflation is really going to start running away. We're going to run away inflation. Interest rates are going to start spiking up, and we're going to have, this great calamity. Well, it just has not happened, which, as a side note, points to the fallacy of trying to actually predict a lot of economic things, because in economics, it's a self-adapting system. So whenever you have a lot of people predicting something, what happens is people, individuals in the marketplace, businesses, everything, they take action to prevent that negative thing from happening. And so then it doesn't happen. It's almost like a self-fulfilling prophecy in reverse. That when it is so well known and so well predicted that inflation is going to be very high, that people take action to prevent it from happening, and then it does not happen. Well, that's exactly what we've seen. We've seen interest rates continue to stay low. We've seen inflation to continue to remain modest. Now, I realize there are different ways of measuring inflation, and food and energy and those type of things have certainly gone up, and I'm not disputing that. But inflation, I talked about this before on the show too, what you're talking about is a rise in prices. When the price of milk goes up or the price of gas goes up, inflation is a monetary phenomenon. It's when you have too much money chasing too few goods. Inflation is a monetary problem. And we use the consumer price index as a gauge of inflation. If you really dig into it, the CPI is a gauge of inflation. But true inflation is when you have an oversupply of money chasing too few goods. Anyway, so that has not happened yet. We haven't had runaway inflation. We have not had interest rates go up. If you look at Japan, they've had a near zero interest rate policy, for 20 some odd years now. So it's not a foregone conclusion that interest rates are going to go up. Well, that brings us to our first break. When we come back, we'll continue talking about whether investors should fear rising interest rates or stay with a diversified portfolio.